In the early hours of September 16, 1992, the world remained in slumber, oblivious to the impending events. On the 33rd floor of a skyscraper in Manhattan, one individual had been awake for several hours, awaiting a pivotal moment. His coffee had turned cold, but George Soros was not preoccupied with it. His mind was focused on London. Before him lay 3 telephones, a flickering computer screen, and a note he penned the previous night. 4 simple words were written at the culmination of 2 years of meticulous, intense preparation. Outside his window, Manhattan was commencing another typical Wednesday. However, it would soon transform into anything but ordinary, as it was on that morning that Soros decided to undertake an unprecedented action in the financial landscape. He was poised to execute the largest currency bet in history and potentially walk away with $1 billion. This is the tale of Black Wednesday. The day one trader brought down the Bank of England. To grasp Soros's actions that morning, we must rewind to 2 years earlier. It was 1990. Europe aspired to unify its economies under a single financial framework known as the ERM, or European Exchange Rate Mechanism. This system tethered the currency of each member nation to a narrow range against the German Deutschmark, aiming to create stability, integration, and a collective economic future for the continent. Britain became a participant, pegging the pound at 295 Deutschmarks, enforcing a barrier below which it could not fall. While it appeared strong and solid on paper, bolstering the pride of politicians, the truth was that the British economy was disintegrating underneath. Unemployment was on the rise. Growth was dwindling, and businesses were suffocating under soaring interest rates. The pound was not genuinely strong. It was artificially supported, akin to a dam riddled with unseen fractures. Instead of averting his gaze like everyone else, Soros meticulously examined each fracture over the course of a year. Quietly, his quantum fund began borrowing billions in British pounds, converting them into Deutschmarks. This maneuver was termed a short position, a gamble that the pound would decline, and Soros was clandestinely scaling this bet. By September 1992, his commitment in short positions against the British pound had ballooned to $10 billion. This colossal trade was virtually unknown to the world. When the second week of September rolled in, the fractures began to expose themselves. Traders throughout Europe started sensing what Soros had identified months beforehand. The pound was misvalued. They began selling pounds, not with the same assurance Soros possessed, but they too felt the pressure. Responding to this, the Bank of England intervened, purchasing pounds in the billions to uphold the peg. However, each pound they bought depleted their foreign reserves, and such reserves are not limitless. Then, on the evening of September 15th, a phone call altered the course of everything. Soros's chief strategist informed him, "The Bank of England is depleting its resources. The pressure is intensifying." The strategist proposed, "I believe we should increase our stake." Without a moment's hesitation, Soros directed his quantum fund to elevate its short position from $10 billion to $15 billion. This marked the largest currency trade ever made, betting against the British pound. By morning, every phone on his desk was ringing as the market sensed the approaching storm. At 7 in the morning, London time, the pound faced immediate and intense pressure. The Bank of England injected over £2 billion into the market within the first hour. Though the pound found temporary stability, for a fleeting hour, it seemed that Britain could indeed hold its ground. The Chancellor of the Exchequer appeared on television, declaring that Britain would do whatever was necessary to remain in the ERM. An emergency increase in interest rates from 10% to 12% was issued, all while the world held its breath in anticipation. However, the selling resumed, culminating in a deluge of trades. By 11 in the morning, the Bank of England had lost its grip. The pound entered a freefall, prompting another drastic rise in interest rates from 12% to 15%, the highest recorded in modern British history. Still, the pound continued its descent. By 2 in the afternoon, the Bank of England had expended £27 billion in reserves, leaving them drained. At 7:30 in the evening, Norman Lamont reappeared before the cameras, his expression conveying total dismay. Britain was officially withdrawing from the European Exchange Rate Mechanism, effective immediately. The pound was now set free to float, plummeting by 15% within minutes. In a single trading day, the entire economic strategy of a nation had crumbled. George Soros did not celebrate or make calls. He remained in his office, awaiting the tallies. His trading team commenced processing the positions, and the calculations started to roll in. Each pound borrowed at 2,95 Deutschmarks was now being reacquired at 2,50. The staggering difference compounded across the $15 billion positions was astounding. The first figure reported was $100 million, followed by 200, 500 million, and finally, the ultimate number arrived, bringing a profound silence. $1 billion earned in a single trading day, the most lucrative trade in financial history. Later assessments even suggested the final tally was closer to $1.5 billion. The following morning, the British media dubbed it Black Wednesday, marking a day of national humiliation. The moment one individual walked away with $1 billion, he earned the title of the man who broke the Bank of England, a label that continues to follow him. Yet, what the headlines failed to convey was that Soros didn't accrue $1 billion in merely 24 hours. He achieved it by being correct for 2 years, while others hesitated. He grasped a fundamental truth. Markets do not always operate rationally, and governments are not infallible. When reality clashes with policy, reality prevails every single time, without exception. Soros analyzed the British economy when it was uneventful, devoid of crises when no one was paying attention. He expanded his position when the conviction was crucial, not merely when the crowd finally acknowledged it. He maintained a position worth $15 billion amid governmental threats and a chorus of journalists labeling him reckless. On the day that everyone was focused, he simply reaped the rewards the market owed him. The most significant trades in history are not executed in a day. They are recognized in the moment, shaped through months of research, patience, and conviction. Most individuals lack the endurance to sustain this. The Bank of England lost £3.3 billion on that day, while George Soros gained $1 billion. Identical market, identical information, identical 24 hours, yet vastly different levels of readiness. The morning after Black Wednesday, a journalist inquired whether Soros felt any regret. He responded, "Whenever I identify a wrong, I strive to correct it. The market addressed it. I merely participated." This distinction highlights the divergence between traders who alter history and those who merely witness its unfolding.